From the American College of Financial Services, welcome to Annuity Insights, in partnership with New York Life.
Welcome to another episode of the Annuity Insights podcast. I'm Michael Finke. I'm a professor of wealth management at the American College of Financial Services, and I'm here with Steve Parrish. Steve is a professor of practice, an expert in all things retirement here at the American College, and I'm also here with Justin Bateman. Justin is a corporate vice president at New York Life, and we're here to talk about annuity taxation, which is, I think, one of the most misunderstood topics in financial planning in general. This is one of those topics that I think everybody needs to know a little bit more about, including people who think that they're an experts in annuity taxation and financial planners in general. I think what a lot of times financial advisors, even if they don't specialize in annuities, will have a client who comes in with an annuity that has maybe significant gains in it. What do you do with an annuity like that? What are the ins and outs? What are the positives and negatives of annuities when it comes to meeting financial planning goals? So let's go ahead and get started with you, Steve. The way that I think about annuity taxation is that the government incentivizes the use of annuities as a way to store money for the purpose of supplementing Social Security as a source of income in retirement. Is that a fair way to think about it?
Michael, that's a fair way to think about it. I think we have to look at what starts the confusion is where is that annuity sitting? Because frankly, some annuities are sitting in an IRA or nowadays even in a 401k. It's another investment. So I think we have to put that off to the side and say there's normal rules for IRAs and all that. So we're really talking about non-qualified annuities. And yeah, I agree with you. Basically, the idea is it's meant to be a deferral of the money now so that you can take it out at retirement. I mean, that's what those were invented for.
And Justin, do you agree? Do you think that the best way to think about annuity taxation in a non-qualified account is that the government is creating an incentive to spend the money in retirement?
I do, Michael, yeah, and thanks for having me. You know, when you look at how the IRS looks at non-qualified annuities, being able to defer taxes, certain aspects of when they apply a 10% penalty with withdrawals, right? It mimics an IRA with age 59 and a half, so I think you two hit it on the head when explaining taxation, particularly when it comes to the non-qualified space, and then purely looking at them as retirement vehicles, because we'll often get questions. It's a fixed deferred annuity. I funded it with cash. I want to take my interest out. Before age 59 and a half, how come you're telling me there's this 10% penalty? And just as you alluded to, they're looked at as retirement vehicles in the eyes of the IRS, money meant to be spent later down the road.
Okay, so Justin, you make a great point that there's a difference between, say, putting money in a fixed deferred annuity or a multi-year guaranteed annuity and putting money in a CD. And the difference is that the government was going to give you this tax deferral. And that tax deferral, we've done analyses on the differences between, for example, MYGAs and CDs or bonds as a way of accumulating assets in a bond-like vehicle in a non-qualified account. And really, they dominate. So, not only do these fixed deferred annuities provide a higher guaranteed yield than CDs, very much comparable to a corporate bond return, but they do it in a tax-deferred fashion. But there are these caveats. So let's talk about the caveats, Steve, when it comes to a very simple type of accumulation annuity. And we can talk about multi-year guaranteed annuities as kind of like the baseline. There's also, there are a million different types of fixed annuities, including fixed annuities that have a interest growth that is tied to some sort of an index, but they basically all kind of work the same way. How should we be thinking about those types of annuities and that tax deferral benefit?
Okay, so we've established that the advantage of a deferred annuity is that you defer the taxation. So as Justin pointed out, age 59, you have to hit that before you avoid the penalty, just like an IRA. So what happens once you get to the point where you're going to take some of that money, whether it's a MYGA or a variable annuity or whatever, is you really have two things that happen when you want to get at the money. One is if you just plain pull it out, it's going to be subject to ordinary income tax, and that is a different tax scheme than if maybe you had it in mutual funds or something like that. So it's going to come out as ordinary income. That's becoming a bigger and bigger issue because more and more people are planning to take their money as some kind of guaranteed lifetime withdrawal benefit, and we can talk about that later. But in other words, they're going to get at their money by drawing it down versus your other choice, which is to annuitize it. So you get to the point where you're ready to start taking your retirement income, and there's this whole regime that's used called the exclusion ratio, which basically looks and says, how much did you put into it? How much is it worth now? And that ratio will tell us with every single payment you get, which is ordinary income and which is just a return of basis. So at retirement, those are your two main choices. Take it out in some form where it's ordinary income, which is often happens with these very popular guaranteed lifetime withdrawal benefits, or annuitize it. And then one other thing, Michael, we should mention, what happens if you die? What happens if you die before you start taking the money out? That's a whole new story. But the bottom line of that, and we can talk about it in more detail, but it basically says whoever the beneficiary is, when they get that money, they're going to pay ordinary taxation on whatever the gain is in that deferred annuity.
So, Justin, are there examples that you've seen that would be helpful for advisors to understand how to use annuity taxation, just very basic, strategically, and then what are some of the pitfalls?
It's a great question. I agree with Steve when it comes to the exclusion ratio aspect of it. That's a key benefit of lifetime income annuities or income annuities in general. So what the exclusion ratio is doing is, as Steve mentioned, you're essentially spreading out gains typically over your life expectancy. So if you're moving a deferred annuity with many years of built up gains into an income annuity, the IRS gives treatment with income annuities, and as Steve mentioned, what's called the exclusion ratio. So a benefit there is you're taking all of those gains you've accumulated over the years, maybe in your accumulation phase, and once you turn that income annuity on, it's not like you have to wind down those gains in quick manner. Typically, the exclusion ratio is spread out over one's life expectancy, or if they set it up for two life expectancy. So that's a key benefit, not having to take out gains immediately from a lifetime income annuity, compared to, Michael, you mentioned pitfalls, if you will, or things to be cautious with. The GLWBs on variables or FDAs, that is income for life, but that is last in, first out. So the taxation there meaning all gains come out first. You don't get to spread those gains out over your life expectancy like a SPIA or DIA. So it's more along the lines of being cautious. While the GLWBs have a very nice space in the industry, you just want to be aware of the taxation, that you're eating first into all of those gains. Then you eventually get to your basis when it comes to a taxation standpoint.
I love modeling this stuff out. I'm such a geek when it comes to trying to figure out how taxation is going to affect clients over time using different types of distribution regimes. So in my research, what I've found is that the ability to choose when you're going to realize those income taxes is incredibly valuable. So if you're basically accumulating all this money within an annuity wrapper, and then say you get to retirement and you may have a period before RMDs kick in where your taxable income is very low, or you may be a small business owner and you have a year where your taxable income is very low, you can actually use annuity gains to fill up some of those tax buckets at a much lower tax bracket. And that's something you can't do with, say, non-qualified bonds or CDs. You just, if you have $300,000 of bonds and they earn 5% interest, you've got $15,000 of ordinary income. With the annuity, you can just keep it in the annuity wrapper and then pull the money out strategically. Now, Justin, you talked about taxation on two forms of lifetime income. One, annuities, annuitization using an exclusion ratio. The other, some sort of a lifetime withdrawal benefit, which is, I think, far more popular now. But it's something, especially in non-qualified accounts, that people need to pay attention to. So, Steve, I've modeled these things out, and I think it's so fascinating because when you annuitize, let's say I gave the example of $300,000 in a bond, maybe providing $15,000 of interest. With the annuity, let's say you put $300,000 into it, you may be getting about $20,000 of annual income, and it may only be that $5,000 of that is taxable, but up to a certain age. So how does that work?
Well, you tell me when you're going to die, I'll tell you when to buy. So the whole idea is that when you've annuitized it, they're not using your life expectancy. They're basically using the population's life expectancy to come up with that number. So if you die prematurely, in a way, you're pre-funding or you're funding the people who live too long. So that's why I say when you can't look at just pulling the money out with a lifetime withdrawal benefit versus an annuity, because you really have to look at how long you expect to have. The idea from a tax standpoint is that they have tables, and they basically say that exclusion ratio spreads it out over that life expectancy, not your life expectancy, but the general population. And then again, you get this kind of mortality premium if you live longer, though something people don't always recognize is you will start paying income on anything past that life expectancy.
So, Justin, what are some things that people can do? Because when you annuitize, it is the case that I think after age 85 or so, the income goes from being only partially taxable to fully taxable. So are there strategies to then manage that increase in taxable income or increase in taxes from income after you reach that older age?
Yeah, no, it's an interesting question, Michael. I think, from a strategy standpoint, the good news is, as Steve mentioned, that happens where the payment becomes half taxable and say half non-taxable, right? The exclusion ratio, where it becomes then, fully taxable is usually later on down the road when the individual is much older, past or at life expectancy, mid 80s to early 90s. So from a strategy standpoint, it might be a simple answer, but I think just planning for when you know that's going to happen, a little bit of change in your take-home income because of the exclusion ratio disappearing. But usually the client, when they purchase an immediate annuity, they're really realizing the benefit of the exclusion ratio for a majority of the policy. Now, if they live longer, which is what the products, the solution's designed for, it is going to be fully taxable, as Steve mentioned. I think simply just planning for that, understanding that you're going to be having a little bit less of take-home income. Are there other sources you can tap into to maybe get your income back up to a level that you were used to? Maybe you have other solutions out there in the annuity space that now you can annuitize and get yourself back up to that take-home income. So I think it's more just carefully planning around the time when this might happen and having other investments at the ready to maybe help supplement some of that income that's in your pocket once full taxation hits that income annuity.
Steve, if only there was a tax-deferred annuity that would provide income later on in life to boost your spending.
If only. I wish someone would come up with a solution for it. Wait a minute. What if you had this annuity that you already know how much you're going to get, but you don't get it now? Why don't we wait until you're older? And of course, what I'm referring to is the deferred income annuity. This is a concept that took a long time to finally come out, but the idea with the deferred income annuity is you put down your money now, and you basically say, I want it to kick in at a particular time in the future, and at that point is when you get, if it's non-qualified money, the exclusion ratio. It's a great idea because we're sitting in an environment where most people have 401ks, they don't have defined benefits. So they don't have any kind of income they can't outlive other than Social Security. With a deferred income annuity, you figure out what age you want that to kick in, and it starts doing that, and it's an income you can't outlive. And I suppose we could add in that you can also do this on the qualified side. Obviously, the reason Michael's laughing is I'm such a fan of QLACs, because with a QLAC, what you've done is converted some of your 401k money into a defined benefit. You can kind of think of it as a DIY DB in the sense you took some of that money and put it into an income that you can't outlive at an age in the future.
Yeah, so QLACs, obviously nobody buys them, but many of us who are experts in this area are just in love with this concept of an annuity within a qualified account that allows you to get a certain amount of tax deferral benefit. With a QLAC, you don't have to pay RMDs. You can say take a couple $100,000 in your IRA, use it to buy a deferred income annuity. You don't have to pay RMDs between 73 and let's say age 85. And then at 85, the income kicks in, of course, is fully taxable like all income from an IRA. But it gives you that supplemental income later on in life. It can even be a way of dealing with long-term care costs. So it's getting the mortality credits when they are the largest, that extra boost in spending. So, you can take $200,000 and you can get about $100,000 a year, depending on when you buy the QLAC, if it's, at the very beginning of retirement. At today's interest rates, they're pretty generous.
And if I could just add in, this is kind of like Roths were 20 years ago when people said, why on earth would you do some kind of crazy thing where you could defer the income and here you're going to take it? Well, obviously, Roths are not very popular. Well, I think the same thing is going to happen with this, where they will become more popular. The objection that we hear is, well, wait a minute, what happens if I die? Okay, what happens if I die before that stream comes in? This is longevity insurance. So the simple fact is, yes, you could die, but people buy life insurance, people buy fire insurance and property casualty. Would you rather make a little mistake and turns out that, gee, you really didn't need the insurance, or a big mistake that you're going to be, living in your car and eating cat food because you ran out of income when you were 85? So you have to look at it as longevity insurance.
Justin, I think if you're an advisor, how many QLACs do you see sold? And of those QLACs, how many of them have some sort of return of premium option?
Right. So if you're an advisor, the word QLAC might be foreign to you, right? But it's not. What's interesting to many clients, it's not. They do their own research, as we know on this discussion, right? Clients will typically go into their advisor's office and say, hey, what is this thing that I can push out RMDs way out until age 85? Wait, I can also add my spouse onto the QLAC, so it's covered over 2 life expectancies. So I agree with Steve. I think right now it's a niche type of plan type that eventually will be taking off. The IRS with Secure 2.0 made the rules to fund a QLAC much more easier. They had this convoluted type of formula that you can only add so much to a QLAC. That was previous rules, but with Secure 2.0 rules, anyone with an IRA can invest up to $210,000, and they can add their spouse onto it. And then, Michael, back to your original question, if the individual passed away before income started, in many instances, life with cash refund, their beneficiaries just get their premium back. So someone's getting that money, someone's being made whole. I think it's important for advisors to really understand that QLAC is not something that insurance and annuity providers came up with. This was derived within the government, within DC, basically telling individuals, hey, there's this deferred income annuity out there. There's really beneficial income down the road. We're even letting you push out your RMDs to age 85. This is something you should take a look at. And I think it's really something advisors should really dig their heels in, start to understand, because it's a solution that many clients will eventually understand. And if advisors aren't ready to have that discussion, it's something they should be ready to have when that client walks in the door.
Yeah, and Steve, I guarantee you that when you talk to any economist about whether or not you should get a return of premium option on a QLAC, universally they will say no, that you maximize your income. That's the purpose of this longevity insurance. And you and I are probably a little bit more Vulcan that way, that we can do that. But I think the average client, is probably not able to overcome that barrier. But especially if you have a higher net worth client where, $200,000 is not a huge part of their net worth, and you want to create this automated income later in life, and they're in a higher income tax bracket, they have a significant amount of qualified assets, the QLAC really is a no-brainer.
Yeah, I'm not an economist, but I play one on TV. And yes, I have a QLAC, and no, I do not have a refund feature. And each year I have to explain to my wife, how does this work? And I have to remind her that the downside is maybe the kids inherit, let's say it's 100,000 less because I die. But if I live a long time, or you live a long time, because I was smart enough to add her to the QLAC, as Justin said you can do, suddenly she decided that's a great idea because she wants to live a very long time and live to the income that she's become accustomed to. It will catch on.
As the baby boomer retirement wave crests, it's time to position yourself as the ideal partner for this growing pool of clients with the American College of Financial Services Retirement Income Certified Professional designation. As an RICP, you'll get the specialized knowledge to help more clients with complex retirement planning needs. With the convenience and flexibility of the latest in e-learning design, The RICP delivers applied knowledge from over 45 retirement experts on Social Security, taxation, income planning, Medicare and Medicaid, long-term care planning, and more. Get started in our 3-course program today and become an RICP in 12 months or less. Now is the time to strengthen your client relationships with deep expertise to address the unique challenges of retirement. See how you can expand your opportunities at theamericancollege.edu/RICP.
If you are enjoying this content, please check out the New York Life Annuities Education Center, designed to support you in growing your annuity business with the tools, insights, and resources you need. Visit the Advisor Education Center at newyorklifeannuities.com.
Let's shift gears a little bit and talk about GLWBs, because Justin, you mentioned that GLWB taxation is a bit different than using the exclusion ratio on annuitization. Steve, how does GLWB taxation work?
Well, as Justin talked about, what you're really getting is your money back. And so you go into I always have to say, is it LIFO or FIFO? So it would be LIFO, meaning the last money you've built up. In other words, you've got 100,000 in there, it's built up to 150,000. Well, as you start drawing down that guaranteed lifetime withdrawal benefit, what you're essentially doing is taking withdrawal from your annuity, and so they're going to tax that first. The practical effect is that means you've hit retirement, and the one thing that's a myth out there is you hit retirement and your tax bracket automatically goes down. It doesn't always do that. So you have good news, you got this money coming in, but you are going to pay ordinary income tax. And one of the challenges with that is that may fuel your modified adjusted gross income, and you're going to start looking at things like the IRMA premium on Medicare. And so you may be in for a little bit of a surprise in that you're going to have more taxation when you're retired than you expected. I'm not saying this is a case for why necessarily to use an SPIA to annuitize it, but that really does need to be factored in, because it's going to, for a lot of the years after you retire, it's going to be taxed at ordinary income.
So one of the things I think to consider is that you have this period where you're essentially paying tax on all those gains. So the income from a GLWB is fully taxable, and then it's not, right? So now you start eating into the principal. But then when the principal gets used up, then again, it's fully taxable. So this creates, I think, the need for being, I think you have to be more careful for planning for income from a GLWB, because you do end up with these periods where you have more taxable income, less taxable income, and more taxable income. So Justin, what have you seen in the field for planning issues related to GLWBs?
Yeah, Michael, I think you hit it on the head. When clients start turning on income, remember, with GLWBs, some of it depends on, obviously, it's usually a level stream of income, but depending on how much is within that payment, you have a different set number of taxes each year. I have seen clients confused when it comes to taxation, particularly when the spouse takes over the GLWB stream. A lot of these GLWB streams are joint life. There's questions along, well, it was fully taxable. We went into our principal. We had a nice tax-free stream of income. And, as we know, sometimes clients have short-term memory. They're thinking that tax-free stream of income is for life. Once that's over, then the insurance company is now on the hook, and that's a fully taxable income stream. So I've seen, as you mentioned, a little bit of confusion when it comes to, it's almost like an up and down road on the taxation of GLWBs, and really understanding how that tax stream works when you turn on that income is super important. Oftentimes, clients have very short-term memories that they remember one thing and the next couple of years something else happens. And just be very cautious when explaining to clients, LIFO, last in, first out, how that might affect, the entire financial picture. So from taking a step back, Michael, from the original question, what I've seen is a little bit of confusion, right, in understanding how taxes work. You have part of the journey that's, fully taxable, then it's tax-free, and then you're back to being fully taxable. So just, a little bit of confusion when it comes to that. But if you're properly educating the client, they understand it. It's a great lifetime income strategy, but you want to be careful in how you explain the journey of that income stream, because it could, have 3 different phases essentially.
So, Steve, let's talk about using an annuity within a qualified account, because I hear, a lot of financial planners saying, no, 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 you should never use an annuity within a qualified account because the benefit of an annuity is that tax deferral. So they should only be used in non-qualified accounts. But those of us who study this are like, well, no, and in fact, because of Secure Act, the use of an annuity within the qualified account has actually become more efficient. So explain how that works.
Right, and what you commonly used to hear, I don't hear it as much anymore, is why would you take a tax-deferred instrument inside a tax-deferred instrument? And that's just kind of a bunch of words. I mean, what is the practical economic effect? Annuities stand on their own merits, and annuities have different features. Some of them have death benefits, some have different internal features as to when the income turns on, all those wonderful...
It's almost like, Steve, if I can interrupt, it's almost like saying, why would you invest in an ETF inside a qualified account? Because the ETF has, one of the reasons to invest in an ETF is because it has these tax deferral benefits, but it also has other benefits.
Yeah, so you look at the contract for its benefits, not just look at it from a tax standpoint. And as you said, the Secure Act very much acknowledges that because we're sitting in a 401k environment, we're really not getting defined benefits, not getting lifetime income. And people, by the way, as someone of a certain age, people at a certain age say, I want to play with the grandkids, I want to go golfing, I don't want to sit here and do all this modeling out. So by having some of that money in your 401k, essentially, as I said before, it's kind of like a do-it-yourself defined benefit, because when you're ready, you can turn on that income stream from your 401k because it's sitting inside a contract that has that capability. Other contracts don't. Mutual funds can't do that, but an annuity can turn on that income stream.
And Michael, can I
just
jump in there with
Yes,
Secure Act
please.
and income annuities? There was Secure Act 2.0 had a very beneficial section for income annuities, immediate annuities, SPIAs. Before Secure Act, when an individual bought a qualified income annuity, that income annuity was on its own little island, satisfying its own RMD self. With Secure 2.0, the income from that lifetime income annuity can now be used to satisfy RMDs for outside liquid IRAs. And it's a concept that many advisors are gravitating to, many clients are gravitating to, because the income from the SPIA is typically very attractive, right? It's an irrevocable product, nice income stream in return. Before Secure 2.0, you could not apply those SPIA those SPIA payments to satisfy outside RMDs. With Secure 2.0, it was a big win for the annuity industry. You could take your IRA SPIA payments and satisfy RMDs for outside liquid IRAs, meaning if the SPIA payment is $14,000 and your total RMD bill is $13,000, you only need to take $1,000 out of those liquid IRAs and you're fully covered from an RMD perspective. A little bit in the weeds, but I've been seeing a lot of advisors gravitating towards this concept, and some of the high net worth clients that are reading about their finances on a day-to-day basis have caught on to this as well. So a huge win with Secure 2.0, and I did want to point that out.
And that's a great answer that advisors can give to clients who are worried about the fact that their RMDs are growing. They hit the age where RMDs start kicking in. They get upset about it. Is there anything I can do? Well, you can strategically use an annuity to eat up a pretty big chunk of that RMD threshold. Any other planning issues related to annuities and qualified accounts, Steve?
I think one of the issues we're all going to have to face is now we're going to start seeing those more and more in plan, meaning the 401k is going to be offering that because, as Justice pointed out, you're in a situation now where the 401ks are going to offer it. So as an advisor, one of the things you have to look at is what's sitting in the 401k, what options do you have? Still, commercial annuities make all kinds of sense. So it's not just a yes or no, but you really now have to, as a fiduciary, look and say, do we want to use some of the annuity options inside the plan, or are we going to essentially roll it over when we hit retirement?
And Steve, some of these products actually are GLWBs. So does the GLWB structure also benefit from that RMD change that was made in the Secure Act?
So I'm going to let Justin ask that one or answer that one as I think that through. I mean, the one thing I do want to point out is that with the GLWB, you have the option of figuring out when you're going to turn it on. That's one of the nice things. And the longer you wait, the higher the amount you're going to get of the GLWB.
Yeah, Steve, to jump in there, so the GLWB, right, is obviously looked at as a withdrawal. So the IRS's view is if that's a withdrawal and it's close to your total RMD number, that's completely fine. The issue is, though, if the client wants to take out more, right, and match RMDs outside of that VA with a GLWB, you're coming close to blowing up the rider and reducing income in the years, going forward, because you want to take this nice large number out of your VA with GLWB, satisfy your total RMD bill, and then leave your other liquid IRAs alone. Totally fine with that, but then you're skirting on the rules of the rider itself. You can't take out more than typically the rider prescribes, and if you do, sometimes you blow up the rider. So the Secure rule, the Secure 2.0 rule, was really geared towards lifetime income annuities and using that type of income to satisfy outside liquid IRA RMD balances.
Now, Steve, a lot of these conversations that we've had about annuities have emphasized the value of protecting against longevity risk, that it is an idiosyncratic source of risk. The consumer doesn't get any benefit from bearing it. So this is why within a qualified account, putting part of the money into an annuity still reaps that exact same benefit as it does within a non-qualified account. So you get that benefit of being able to spend more money from your savings in retirement, all else equal. Now, talk to me about what happens both within a non-qualified annuity and a qualified annuity at death.
Okay, that's one that's often misunderstood. On the qualified side, it's not really all that difficult. I mean, it has the normal beneficiary rules, and we certainly don't want to get into Secure Act and the 10-year and 5-year rule, but all those things that you're used to. I mean, it could be some other form of an investment. You have those same rules, and we won't get into QLEX because we already covered it. I really think that the area that's hot is dealing with non-qualified annuities, because it doesn't have an RMD where you take it out under specific rules. So the IRS does have some unclear rules that are confusing in the first place, but it even more depends on who the insurer is. What does the contract say? And they're all over the board, and I'll be curious where Justin is with this, but some allow annuitization for the beneficiary. Some provide a lump sum, depends whether you're married or not as far as the beneficiary. And it seems to be very dependent on whether the contract is like owner focused or annuitant focused. So this is a big issue because you get a big hit for that beneficiary when the owner annuitant dies and suddenly all this money comes in, a lot of it being taxable. So you have to, as an advisor, really dig in, look at what the contract says, and find out what your options are, because they vary all over the map. And I'd really be curious to hear what Justin at the street level says happens when you get into these situations.
Steve, it is interesting, and each insurance company can draft their own beneficiary endorsement, and guess what? Each beneficiary endorsement can have its own rules. Typically what you see is either a lump sum taxable distribution or the ability to annuitize over one's life expectancy. Now, getting a little bit nerdy here, there is a benefit that not many advisors know about for non-spousal beneficiaries. On a deferred annuity, and if you're a non-spousal beneficiary on a non-qualified basis, the IRS does allow you to take that death benefit as a non-spousal beneficiary and 1035 exchange that death benefit into what's called a non-qual stretch. Mimics basically an inherited IRA where withdrawals have to start after 1 year from the date of death of owner. But there is this little sliver that many advisors are not aware of. There are many publications out there. It's called the non-qual stretch. But non-spousal bennies do have the ability to 1035 exchange that death benefit with all those built up gains, put it into a non-qual stretch in their name, let that money sit there, but similar to the old school inherited IRA, withdrawals have to start within 1 year of death based on their life expectancy. But there is a way, this is taxation, right? There is essentially a way for one generation to have a deferred annuity, all of these built up gains, pass it on to the next generation, then 1035 exchange that money into their own name. with withdrawals then eventually starting. So it's a fascinating strategy that many advisors are not that aware of, called the non-qual stretch. So I had to throw that in there. It's such a beneficial type of option for non-spousal bennies that also many insurance and annuity providers are also now offering.
And it kind of goes without saying that if you can stretch out that payment from the inherited money from the annuity, then it makes sense to stretch it out as much as possible to reduce the amount of taxable income that you're getting every year.
Exactly.
So let's end with a discussion about variable annuity taxation, because variable annuities, like a fixed annuity, they provide this wrapper of investment assets. And again, I've done a lot of research in this area, and that wrapper can be seen as very beneficial for certain types of assets. And we had a really interesting conversation with an expert on the use of the annuity wrapper, saying that what's happening. There's a progression in this area where very sophisticated, high income, high net worth investors are using that variable annuity wrapper essentially to wrap tax ugly assets. So, Steve, talk to me about why that's the case and why it is that you should pay some attention, especially in a non-qualified account, to whether the variable annuity makes sense when you're doing asset location.
Right. Well, I mean, the reality, obviously, with a lot of our clients is they're in high tax brackets while they're working. And so to be able to grow some of that money in a tax deferred basis, as we've been talking about here, is great, but they want control. Well, that's where the variable annuity comes in, because they get to say what sub-accounts it goes in. So in many ways, it's a wrapper. I just think the advisor needs to look at the details, because you can get into situations where there might be the cost of a GLWB or M&A charges that get in there. And so you don't want to be in a down market and suddenly have a problem with that annuity. So I just don't want to call it something other than a wrapper, because really variable annuities have their own advantages. Many of them have death benefits. We talked about GLWB, all these kind of things that in and of themselves make a lot of sense. So you look at it as a contract, and that includes what we've been talking about for this past discussion, is you have to factor in that if it was sitting in mutual funds, a lot of the taxation would have been capital gains and some ordinary income, whereas here you've put it off, but when it starts coming out, you're looking at ordinary gains on it. So look at it as its own contract, model it out that way, recognize it as some features that a mutual fund doesn't have. But yes, it is also a wrapper for high net worth people to avoid taxation till much later.
Michael, can I piggyback off of that when it comes to the VA sub-accounts? I think an important aspect of, and Steve hit it on the head, but an important aspect of VA, with mutual funds, if someone wants to change a strategy, one mutual fund to the next, typically with non-qualified funds, right, that's a taxable situation. With a VA, if you're reallocating within the VA, within that sub-account universe, and want to change strategies, that's not a taxable event. You're just shifting your strategy within the VA wrapper. I see many clients jump into the fixed account option within the VA for a little bit of protection for a little bit of time until they're ready to get back into the market. And all of that money movement, obviously you want to be aware of money market rules and not overexposing yourself to doing that, but shifting strategies within the VA sub-account landscape within your VA wrapper is not a taxable event, meaning you can go from large cap growth, and if you want to shift over to a mid cap sub account type of option within the VA, not a taxable event. You're just shifting your strategy within the VA wrapper. Whereas with a mutual fund, if I wanted to go from large cap growth, now completely move to a mutual fund that's a high yield fund, that's a taxable event, obviously in the non-qualified space. So definitely another silver, a little bit added benefit with VAs, sub accounts, and reallocation.
Yeah, I think another point that is important to make is that the more passive your equity strategy, the less having a VA wrapper makes sense, because passive equity investments are very efficient in taxable accounts. They're an efficient way to transfer wealth at death. So that type of a strategy doesn't make as much sense. What does make more sense is more active types of equity strategies. And actually, we model out the benefits of even something that's, say, 25% active. 25% of gains are short-term capital gains. you get a progressive benefit the longer you hold that type of strategy within a variable annuity, because you get that gains on top of untaxed gains that allow you to, over time, actually increase your net after-tax rate of return by using the VA wrapper. So where it provides the greatest advantage are more active types of equity strategies, any type of a higher yield strategy, whether it be equity or bonds, any type of private credit, say, investments, and that's becoming increasingly popular. And even a general account, like this a general account of an insurance company, remember, is a tax ugly asset. It is, a lot of high yield bonds. It includes a lot of private assets and other types of investments that are very tax ugly. And if you're in a high marginal tax bracket, that VA wrapper becomes very valuable. I've actually said that every advisor should consider getting a variable annuity contract for their clients at some point, just to have the optionality. Because I do feel like, the tax benefits are substantial, and it can't last forever necessarily, and just as a way of protecting against the risk of variable annuities not having the same tax advantages in the future, establish that VA now and use it as a way of housing non-qualified tax ugly types of investments. You can't just ignore it, because it is a substantial benefit, probably underutilized. And then again, what happens to that money at death from a variable annuity in a non-qualified account, Steve?
Well, as we talked about, ultimately you're going to have some taxation. So that's the kind of problems to have. But I just think you build that in as part of your estate planning rather than retirement planning, is saying something could happen. And so we just have to recognize that there's all the things that Justin was talking about for the individual, but there's some options as far as possibly spreading some of that taxation out as well.
And Justin, for an advisor who has a client who comes in and has a variable annuity with a substantial amount of gains, what does an advisor tell them to do with that variable annuity?
Interesting question. I think, as Steve mentioned, you got to make, if they have multiple variable annuities from different providers, make sure you understand the options at each contract level. But I think the advisor at high level really talk the client through the different taxation options. For the beneficiaries, they can annuitize the death benefit, take it as one big lump sum. And then, as I mentioned, I think it's really important for the advisor to know that for a lot of these beneficiaries, I said this earlier in the discussion, are non-spousal bennies. Knowing that non-spousal bennies have the option to 1035 exchange a death benefit from a VA with many years of built-up gains into their own annuity is such a valuable piece of their practice they should be completely aware of. And then, of course, on the qualified side, Steve also mentioned it as well. Just make sure you're up to speed on the inherited IRA rules. They're pretty tricky, but just at least knowing the options for the client, one at the contract level, and then two at the fund type level, really be on your toes when it comes to the options there.
Yeah. And Steve, any last words? Anything that we haven't covered today?
I think we just have to recognize that annuities with some people have a bad meaning for a bunch of historical reasons that frankly don't make much sense. But when you think about annuities, you also have to think about tax, because there's all these tax advantages that are built in with annuities, but there are also these tax traps that the advisor can help the client to avoid. So neutralize the name, call it whatever you want to, but recognize that it is a tax advantage product, but it has some hoops you got to jump through to make sure you maximize the tax advantage of an annuity.
And Justin, any last words from you?
No, I agree. I agree with Steve. You, Michael, everything we've said on this call. Just be aware of all of your options. Avoid the tax traps, and then once that client walks in the door, right? If they're a beneficiary, they're already in a pretty touchy spot. So just make sure you have all your ducks in a row and truly understand, the options for that individual if they reach that point.
Well, thank you, Steve. Thank you, Justin. This was a great conversation. I learned a lot. This is one of my favorite topics. I think it's one of those topics that it probably is not well understood by a lot of advisors, especially advisors who don't deal with annuities very often. So understanding the ins and outs is incredibly important. And thank you for joining us for another episode of the Annuity Insights podcast. And join us again soon for another episode.
Thanks for listening, and we hope you join us on future episodes. Annuity Insights is a production of the American College of Financial Services. Annuity Insights is produced and owned by the American College of Financial Services with generous support from New York Life Insurance Company. Accuracy of information is subject to change, taxes, legal, rates, etc., but believed accurate as of the time of recording, January through April 2025.